Good morning. Final week, chapter 22 through 24. We're going to look at cost reductions, all kinds of good stuff, ending up with tax strategy and software implementation. Boy, that is a wide range. So we'll just go ahead and jump in here. I don't have any additional extracurricular assignments out there. There is one that has to do with Enron. It's one of those chapters of a text or a book that you're reading in Dr. Freeman's class. So I would encourage you to just read that on your own if you'd like. But there's no assignments associated with that. So after I finish today, these 22, 23, and 24, continue to turn in a 2 to 3 page paper on your summary of those 3 pages, and also, and that's for next week's turn-in, week from today, which is, well, a week from tomorrow. This is Wednesday. A week from tomorrow, turn that in along with your Excel spreadsheet on Flex Budget, which should be fairly quick for you to do. And so I'll take those 3 pages that you turn in along with the Excel assignment, and they'll be 5 points for your final week. And if you haven't already, you need to complete that earnings quiz, that earnings management quiz, and submit that as well, because that would be your week 14. This is week 13 that we're looking at today. So let's go ahead and jump in. Cost reduction. It seems like I've talked about cost reductions the entire semester. Let me go ahead and pull up the actual text here. Let me share that. There we go. Cost reduction, and this is, well, there it was. There it is. Hopefully that's being shared. Cost reduction, chapter 22. You think, well, what's this doing in a controller's book? Well, that's because controllers are the ones that drive this in any organization. It was like that at Exide, it was like that at Lear, not so much in NFS, because they being a defense contractor and government contracts, it wasn't quite, back in those days, 30 years ago, it wasn't quite as big a deal as it is now. I think they do have lean and they've got a little chart here showing what's on the left side, implementation difficulty on the left side. And then on the bottom part is cost reduction impact. So you can see they put this into a form to show what you want to pursue and what you do not want to pursue. Obviously, the lower left is the low payback, but it's easy. And then going across the cost reduction impact is high payback and easy. It's the bottom part. So those bottom 2 quadrants there are the ones you want to focus on. There's a term, and he uses that in this book, which surprised me. There's a term that's used a lot in manufacturing about getting the low-hanging fruit, right? If you ever pick fruit in an orchard or whatever, you want to pick the fruit that's, obviously you can reach from the ground. You have to climb a ladder or use any type of a device to get something way up in the top of a tree, because that might be good fruit up there, but it's difficult to get, right? So you want to get the low-hanging fruit. Well, that's what these bottom 2 are, low-hanging fruit. And some of the fruit is better than the other fruit, but he uses that analogy there. In fact, we look at the next page, maybe. Let me do that. There we go. There it is, low-hanging fruit, up there at the top of page 406. I thought that was interesting that he used that term, which is one more reason why I really like this book. But you have to come up with some type of a matrix on what do you want to attack first. And you do want to do the low effort, high output, or good fruit. And they use this exhibit 22-2 and 22-3 to show the ranking of these categories, right? It's important. Because obviously, like spending CapEx, you can only spend so much cash on investing in assets, you want to pick those that have the highest return, unless of course you have some regulatory authority requiring you to do that. So you can read that on your own, Exhibit 22.3. We go on into the next page, itemization matrix. I don't see anything that really jumps out there. Cancel office parties, that'd be something people don't like, right? Save $170,000. Advertising cut back. All advertising is spent on NASCAR sponsorship, drop sponsorship. That's pretty cheap, $380,000. But also, if you probably don't follow NASCAR like I do, but NASCAR is nothing like it was 10 to 12 years ago when it really reached its peak. It's kind of been going downhill ever since. So they're not going to spend money on something that's not getting them viewership, right? Visibility. All right, so you can read all of those. Interesting. And you got to put those in some form of how are you going to attack in that matrix of attack the stuff that's easy that gets you a payback as quickly as possible. Spend analysis overview. You know, when you're putting a budget together, one of the things you want to do is look at your prior year spend, especially when, you know, we talked about forecasting as you're in your fiscal year, and I gave you the example of Exide that our fiscal year was March 31st, when we started working on the budget in late December into January. Once you get into January and you're doing your budget, you're putting together a forecast as well for the rest of that fiscal year. So you would have like a 9+3, 9 months of actual from April through December, and 3 months of projections or forecast. And that 9+3 is a fiscal year, and that's what you would compare against next year's budget. Well, all of that 9 months of actual and 3 months projection, you got to have a spend analysis. What are you spending money on? So one of the things we spent a lot of money on was caustic soda, CAUSTIC, caustic soda, which was used to treat sulfuric acid, was used to neutralize the acid, kind of like soda ash, powder form. But the caustic soda, very expensive. We would spend something like $40,000 to $50,000 a month on caustic soda to treat acid. And as much as you would set up a spend database, you would ask why that is happening, you know, the 5 whys, and you would drill down to it's like your variance analysis you learn in managerial accounting. You've got a price variance and you've got a usage variance, right? Price and usage, or what's the old term? Cost and efficiency. Same thing, cost and price are the same, efficiency and usage are the same. So you got those two things, the price or is it the usage? The other thing with caustic acid is, are you getting the best price that you can get? That's the first part. But then the second part is, why are you using so much? I mean, if you're using a lot of caustic acid or caustic soda to treat your acid, then got these pop-ups hitting. If you've got all this acid that's having to be, well, why are you treating acid? Why is it on the floor to begin with? Or why is it showing up in the reclaim in your wastewater facility? Because that stuff just doesn't ebb into the ground. I guess some of it does, or hit your stormwater sewer. It better not. You're going to get in trouble with the EPA. So you were having to spend a lot of money to treat acid that never should have been on the floor to begin with. And so you got to drill down into why are you using so much? Oftentimes that's the bigger issue than what is the price that you're paying for it. But he's talking about spend database here. How much are you spending? But you got to drill down into more than just spending. You got to drill down into usage as well. Supplier consolidation analysis. They're on page 410. They talk about global sourcing strategy. You got to be careful there, though. They're in the middle of the page. You don't start buying from companies in countries that aren't really as rigorous as they are in the United States as far as the quality of what you're getting. A lot of stories there. You got to be careful. They point out there rather explicitly that labor rates in other countries is far below those in domestically, and that's why companies will choose to go outside there. You see that a lot. You hear a lot about that right now, about we need to build more stuff here in the United States and not outsource. But yeah, they say that until they find out it's going to hit their earnings per share, and then they keep doing what they've always done, try to get the cheapest possible. But you know what Deming says about that is we shouldn't just base who our suppliers are on price. It should be based on relationships, quality, because you're building quality in from the beginning, not just something that we inspect in. And all this stuff really dovetails together. Talks about parts consolidation analysis on the next page, I think. There it is. Didn't really experience this from the standpoint of, I mean, you do try to standardize the motors, the pumps, the various parts in your operation, both on the MRO, maintenance, repair, and operation supplies that are being expensed in your spend analysis. But also you do try even more so to standardize what's going into your various batteries, trying to use components inside that you're manufacturing, trying to standardize as much as possible so you don't have all these different parts. It's easier said than done, especially when you were a plant that was building original equipment product like for Toyota, Nissan, and BMW versus what you're building for Walmart, AutoZone, places like that. Because the quality of what goes in OEM is much higher. It's a much better battery than what you're going to buy aftermarket. It's just a fact. And so the components and the things that you're building are going to be different. But at the same time, you do try to standardize as much as possible in order to, the simpler, the better, especially from a cost standpoint. He talks about MRO there, maintenance, repair, and operations. MRO spend, very big. It's about $500,000 at Exide. That and our electricity bill, $400,000 a month. Those are the two biggest items that really would hit our spend on any given month. So you got to ask yourself what's going on in maintenance and repair, making sure that you're getting the best price and the best usage for that. And maintenance and repair is one of those things that you want to make sure when things are being repaired, what's happening to the old part. It's not going out the door in somebody's lunch pail or whatever, or being stolen somehow. And that's where you got to have a parts crib that's being controlled on what's being purchased, maintained. You know, that was one of the things, even though it wasn't on our books as inventory, even though everybody called it inventory, it wasn't on our books as inventory as an asset. It was expense when purchased, and we had over $1 million sitting there in a tool crib. That PwC wanted us to every month show that we were really controlling what was in there, even though it was expense. They just want to look at your overall operation. Is your overall operation in control? And that was one of the ways that they wanted to use the Sarbanes-Oxley. The SOX 404 were these questionnaires about your internal control environment, or ICE, as they used to call it, internal control environment. A lot of stuff here ties together. Spend compliance, page 413. Maverick spenders. I thought that was a funny term right there. Some employees don't route purchase requests through the purchasing department, do not purchase through the approved corporate online, buy their favorite brand or use their favorite supplier. But if you're a large enough company, you've got pretty good procedures in place that disallows them from really buying from folks that aren't approved. If you're large enough, like an Exide or a Lear, even though you're a large plant location, you can't set up a vendor unless the corporate office allows it. And the corporate office sets up the vendor. You may send the approved request to them, but we had no access to create a new vendor. That's just part of the control. Like somebody signing checks is different than the person that's doing the bank recon. He's setting up a vendor. What's to keep you from setting up a fake vendor? Very common. Set up a fake vendor, fake invoices. And so that's where the corporate office controls who you spend through the accounts payable. On the other side of that, you got payroll that's being controlled by your HR, and that's usually local, that they can set up a employee, but then somebody else is paying that employee. Mainly, the floor is keeping track of the time card, time sheet, time recording, and then payroll is pulling all that together to pay an official person with someone that they say is working on the floor. So here, these Maverick spenders is not as relevant as it might be in a smaller company. But you got to really control who your suppliers are, who your vendors are, that they exist. Spend analysis reports, again, that really supports your whole budgeting process, your forecasting process. And they go into a lot of that detail on page 414, 415, 416. Good stuff there. So that gets us over to 417. You'll learn about all that stuff when you do start doing your budgets, as you will. Workforce reduction analysis. Very important topic here. Workforce reduction analysis. How do you decide when you start laying folks off? Here lately, you've seen cutbacks, local businesses laying off a certain amount of people over a period of time. I know Domtar and Kingsport laid off, I think they've shut their plant down for 3 months because of the lack of paper demand in schools and in general. So 3 months. I'll tell you something that hasn't really been talked about in the news or anywhere, and I've even Googled it, is what's called the WARN Act, W-A-R-N, WARN, Wage Adjustment and Retraining Notification. What is that? That is a law that if you are going to lay off at least 1/3 of your employees, which when you auto a plant, you're going to do that. If you're going to lay off 1/3 of your employees, you have to give them a 60-day notice. In other words, they get to work 60 more days and earn pay. Or if you're going to let them go that day, pay them for 60 days. If you think they may sabotage your business or something. But that's not come up lately, and I wondered why. And then I got to reading the details on that. Well, the WARN Act applies to 6 months or longer. So obviously it's interesting that they've decided that, and probably rightfully so, that they're just going to idle operations at all these plants that are laying people off for 3 months. So they apparently can escape that issue of paying people for 60 days. But I know when I left Exide, they had to pay you 60 days or allow you to work for 60 days, whether you're an hourly employee or a salary person like I was. They paid you 60 days. We didn't work it. They just paid you as sort of a severance on top of some other monies that they gave the staff. But that's something, when you start talking about workforce reduction analysis, you've got to consider that. I remember talking to some local attorneys about the layoff that were coming, because we went from 810 employees down to 250. And that was in 2008, 2009. I guess it was 2009. We'd lost a Ford contract. And you remember that was the last big economic hit that our economy, that the United States had back in the financial debacle. And we lost that customer, so we laid off a large number. And so the WARN Act came into play there. Well, how do you get from 810 employees down to 250 to continue? And in fact, we built back in the ensuing years up until 2013. For the next 3 or 4 years, we built back to where we had about 450 people before they decided just to completely shut down the Bristol location, move what business was there to either Kansas or Iowa. So how did we decide going from 810 down to 256? It's not a union plant. If it's union, it'd just all be based on seniority, and all that would be in your contract that you would have with the union. But we weren't union, and so that gives you the flexibility to kind of do what you want. And so we did what's called force ranking, F-O-R-C-E, force, like forced ranking. And what we would do is each department manager would rank their employees based on, I think there was 5 criteria, and I can't even remember what the criteria was or were, but it's basically evaluating that person's job knowledge, their ability to work with others, just different things there. And so you would give a ranking of 1 to 5 on that, on how you rated that person. And then, of course, out at the end by that employee's name would be a number. And that number being a potential high of maybe 25 and a potential low of 0, that would give you a ranking for that employee in each department. Then each department would decide who they thought, or I guess look at that to see that all areas would be covered. You got to make sure you're comparing people who can do the other person's job, right? Like if you got an accounts payable person here and a payroll person here, similar, they may be different jobs that they don't know what the other one does. But at the same time, you pretty much had multiple payroll people, multiple accounts payable people, multiple inventory, and then you would evaluate and force rank folks to find out who you would actually let go. It wasn't that hard for my department, but if you got 10 people, it wasn't hard to see who you're going to lay off 6 people out of 10. you kind of knew anyway without doing the force ranking. But for departments that like production, where he had, I don't know, maybe 300 people, he doesn't know all his employees. I mean, his supervisor, so he would rely on supervisor input, and then they would ask us, they would ask the staff that maybe dealt with these employees on a regular basis for whatever, say, well, this person's really sharp, I'm not sure why they're ranked so low, and the ranking would be changed based on what we felt like or believed, not just felt, how we believed someone's ability to work in multiple departments and so forth. Because when you're going from 810 down to 250, you want people who are versatile and adaptable and can do multiple jobs and learn quickly. But they don't really talk about forced ranking here, but that's a term that's used oftentimes, and that's an HR term. So, you know, HR is all about making sure things are done legally the correct way, because you do always have the danger of being sued, but I don't think there was any lawsuits or anything over that. Again, if you're a non-union plant, you have more flexibility to do what you want and have the supporting documentation for it. They show here on page 420 this cost roll-up of showing what someone makes, Social Security, all the total costs and so forth, and what impact that's going to have on your budget when you start cutting back. And like I always said, when we do these force rankings, I mean, if you got somebody like this George Fairview making 37.5, guy might be really sharp versus whoever Franklin Enton man is right above there, 142.5. Well, how many of these George Fairviews can you keep for one Franklin Enton, right? 43,000 versus 189,000. You could lay off one Franklin Enton and keep 4 of the George Fairviews, right? When you start looking at it that way, of course, hopefully Franklin Enton has some experience and knowledge that is valuable, but oftentimes they don't. So it gets a little more complicated when corporate office starts saying, well, you need to lay off X number of heads. They always call them heads or whatever. Well, a head is a head. They don't think in terms of dollars, which that's what it should be. How many dollars you need to take out, and then decide who you're going to let go, right? All the stuff to talk about here. 419, I guess I was a page or two behind. 420. And then he goes in to talk about what are the workforce reduction issues, severance package, how much you're going to pay out, getting a WARN notice, WARN, write that down because you're probably going to encounter that at some point. If you lay off a third of your employees in a location for longer than 6 months, then you got to pay them 60 days whether they work it or not. Because usually hourly people don't get severance pay. That's just a salary thing. Accrued vacation. If you had mean 30-20, you had to work that exercise there in Excel for accruing vacation. Big deal, because that's something that employees earn. And if you shut the plant down, or if you even fire an employee, you owe them. You are obligated to pay accrued vacation. Sure about stock grant acceleration, I'm there to experience that. Unemployment insurance, guess what happens when that occurs? When you lay somebody off. I mean, our unemployment up until 2008 was like 0.8%. 0.8% of the first $7,000 of wages. But what is that? That's like $56 a year, right? Always paid in the first quarter, because once an employee exceeds $7,000 of wages, then there is no tax. But that's an employer tax. It doesn't come out of your paycheck. Employer has to pay that. What happens when you lay people off? After we laid off those 500 people, 553 people, still remember that number? Once we laid those folks off, guess what happens to our unemployment rate in Tennessee? Went up to like 12 or 13% on 7,000. So you went from paying $56 a person a year to like $800 and some dollars per year. And I'm sure they're still paying that, although there's very few people left up here in Bristol. I think there's just 2, so what's $840 on 2 people? But for the people who were left, and in that period from 2008 or 2009 until, I guess it pretty much got shut down in end of 2013, they had those numbers of years where where 250 or so had to pay $800 a year, which is a lot. Still didn't make up for all that unemployment for 500 some people, but that's what happens. So companies take into consideration if I have unemployment, and some companies get around that. I know a friend of mine works for one of these large hotel chains. He's a programmer analyst down in Knoxville. I think it's Marriott that he works for. He's in management, but he got furloughed for, I think, 90 days, again, falling under that 6-month term for 90 days. But they apparently, from what he said is, in order for his health care to stay active, he has to have a deduction, which is not much every month for that. But the fact that if his health care stays active, he can't file for unemployment. So they get around, I'm not sure they're doing it on purpose, but at the same time, I think they probably are, by allowing them to keep their insurance, which sounds like an admirable thing for a company to do. But at the same time, if he can't file for unemployment, then that's something they escape from paying a higher unemployment rate later after all of this. Potential lawsuits, always a risk there. Sue the company for wrongful termination. You know, age discrimination starts at 40, believe it or not. We didn't have any of that, to my knowledge, from people being laid off, because the whole plant was being shut down. It's just a question of when. So in some cases, the sooner you get laid off, the better for some folk. Go ahead and try to find a job somewhere else instead of waiting till the bitter end, like in 2013. The lawsuits you always have to take that in consideration, especially age discrimination or disability. If someone has a disability, you have to make reasonable accommodations. So you can't just start getting rid of all your people you perceive as being disabled. So before we start laying people off, maybe this should have been on there before. What are some reduction alternatives? Well, overtime pay. You know, you've heard me talk a lot of times. Two biggest killers in a company is overtime pay and scrap. And close behind that is going to be your MRO spend. But especially overtime pay and scrap are the two big ones. So reviewing overtime pay, don't just allow people to work overtime. You'd be shocked at how many supervisors and managers just let people that work for them kind of do their own thing and work overtime. I never did that. If you said you need to work overtime, you had to have it approved by me before you did it. You've got to do that and drill down into what they're doing. And if they've got more on them than they can do, then some of that work should be given to someone else. I guarantee you, when you start asking questions like that, that's going to dry up as far as people wanting to work overtime and get paid for it. Now, if your salary, you don't have to worry about that. Exempt salary. Use vacation time up. Delay hiring of people. If you've got a lot of turnover, and we always had a lot of attrition at ETSU, not because of wages were high, it's because it was a harsh working environment, very, very industrial, heavy industrial. So just delaying hiring, you're going to have an attrition of your levels of people dropping off. Now, how long can you wait for that to happen, which is what that next one is? That's the question. But just by stopping to hire, you're going to lose people. Hopefully you don't lose good folks, but you do sometimes. Hopefully you lose people that are just don't want to work. And of course, we had a no-fault attendance policy, a point system, where you could point out, meaning if you missed enough, you would point out and get fired for that reason, get terminated. Delay or reduce scheduled pay raises in lieu of a raise, give a one-time bonus. Sometimes folks like that more than a increase. Would you rather have a 3% bonus right now? Let's say you're making $30,000 a year. Would you rather have a 3% bonus, which is what, 3% of 30,000 is $900? Would you rather have $900 now? Or would you rather have a 3% raise for the rest of your career there? Well, 3% raise every week is not much. What's 900 spread over the next year? Of course, then it's each continuing year. But you'd be surprised when people say, well, I'd rather have $900 now than wait for this to just sort of dribble out over the next 12 months, not thinking about the power of compounding that raises on top of that in some future amount. So sometimes you can pay a one-time bonus and people like that more than the actual raise. Require unpaid days off. That goes on as well. Shorten the work week. Maybe cut out a 20% pay cut for everyone by working 4 days instead of 5. A lot of stuff on here. Offer paid sabbaticals. I've never had one of those. That sounds like fun though. 5S analysis. You thought I just made that up, didn't you? This guy, he's lived it. He's lived it. So he's talking about 5S. Now he uses different terms there. First one, sort. What did I say? Sort, straighten, shine, standardize, and sustain. And of course, when I left X, I had added a 6th S called safety, the umbrella. Sort, straighten, scrub instead of shine, right? Standardize was number 4. They got to systematize and then standardize. But really those two are the same. And the 5th one really should be sustain. Too many times folks will start something and do it for a couple of weeks and then stop doing it. And you ask them, when you do these audits, you say, well, I didn't know you want me to keep doing it. Well, yeah, if something's a policy and you've got a procedure in place, you do it until somebody tells you to stop doing it. So sustaining is very important, but I was encouraged that he actually talked about that here. The 5 S's or 6 S's, if you want to throw in safety at the end of it. But systematize and standardize to me are the same. What about check sheets there? Error quantification. You know, it's getting into a lot of what Deming did, and we just really scratched the surface on that in that article that I had you read last week. The 14 points, it's all driven on statistical process control. Let the numbers drive it. And so they show this quantification. You got to quantify what you're doing and make data-driven analysis. Too many decisions are made on, well, I just feel that this or this or this, or I just feel that. I hate hearing stuff like that. Right? I mean, not that anecdotal evidence doesn't sometimes tell you that there's a big issue, but before you decide what you're going to do, have data-driven analysis. And here they're quantifying the errors. Look at this unauthorized deductions taken. That looks like that's the big one, right? 25 out of the 43 is a problem. Of course, customer double pay, you don't want to do that. There's 3 of those. Pays with multiple checks. I guess that's when you're paying the same, you're paying the correct amount, but you're sending it to 2 different checks to the same vendor. No big deal. But unauthorized deductions taken, cash application. This is deductions taken by, I assume, whoever your customer or your client is. Continuing on, error quantification report. Look at the bottom of this page. Fixed cost analysis. You know, everybody a lot of times think, well, that's fixed. You can't really do anything about it, but you can. You need to make sure that your fixed costs are looked at from a spending standpoint just as well as your variable costs, leases that you have, right? That's a fixed cost. You need to make sure those leases are being you're getting good prices on there, good economic terms. You know, all those leases now, just about, they're all on capital leases, asset liability model. But fixed costs, don't ignore that. Next page is here's another term, Ishikawa diagrams. Nobody ever called it that at Exide or Lear. Called it a fishbone. Fishbone. Why is it a fishbone? Because it looks like the bones of a fish, as it says there, Exhibit 22-15. And the problem there lies, and it says it here, major bones represent groups of major causes, or the problem to be solved lies at the head. The major bones represent groups of major causes, while minor bones represent sub-causes. So you're putting this into a fishbone analysis of what's going on in a particular operation. We'll talk about value stream mapping here in a minute. But there's the fishbone. See how it looks like a fishbone? Late delivery to the customer out here, that's the problem. It's another way. See, all these things are not competing. They're analysis like 5S's, or not 5S, 5Ys, and so forth. This is just another way to sort of, in chart form, get the picture of what the issue is out there in front of everyone. So you got material, manpower, policy, machine, product, and environment. And those are the majors, but then within that, you can see the minor issues. Inventory stock out, why is that happening? What about inadequate training for manpower? That's always a big one. New machine operators, you have a lot of turnover. What wages are you paying? You can drill real down into these issues with an Ishikawa. And this is something that is obviously your Toyotas and Nissan are big on stuff like that. But American industry has embraced it as well. But that can be applied in healthcare as well. Value stream mapping, which was back on this other page, that's another very common term that's used, or process that is used to drive out waste in a company. Identifies all the actions required to complete a process. Value stream, value. Are you adding value in your operations, or are they cost adders that really don't add value? I mean, you do have some cost added stuff that you have to do just because you have to do it. Like I talked about with Toyota, inspecting batteries before they finally get put on the truck. You have to do that because of the cost associated from demurrage if you inadvertently ship something that is poor quality. But here's the value stream mapping of showing from submitting a requisition, processing, purchase order, receiving the warehouse, payables, processing. This is purely really an accounting department type of value stream mapping. So it's important that you do value stream mapping in an accounting department, just like you do value stream mapping in manufacturing or value stream mapping in healthcare. And the final frontier will be value stream mapping in higher education. And so they break that down into full-time equivalents, inbound queue time, which is wait time, outbound batch time, overtime, transit time. Very important stuff there that you'll be exposed to at some point in your career if you end up in the corporate world or working in a manufacturing environment. And it says there, VSM works best in highly focused, high volume processes where it makes sense to spend time wringing a few seconds out of repetitive processes. Very true. Very true. You skip on over to page 430. We start talking about waste analysis, but before we look at that, this bottom part of value stream mapping here at the top, what do you see there? Bottleneck operation. Herbie, right? What happened to Herbie? Theory of constraints. The bottleneck operation in any, whether it's a service industry or manufacturing, what's the bottleneck? Waste analysis. They talk about 7 wastes. I thought there were 8 wastes, and I can't remember what the other one was. And it's very important of looking at what's going on as far as cost reduction, about additional processing that occur, especially in manufacturing. Additional processing instead of just, you don't want to ever have to do additional work on something. Defects, inventory. All of these are things that are issues. Motion, is there wasted motion? Is there overproduction? Man, we got a little bit more parts here. Let's go ahead and build and get rid of it. Transportation, waiting time. I forget what the 8 wastes had something to do with people. I can't remember what it was, but we always talked about being 8 wastes. I think I may have had I believe I passed that out to you earlier in the semester, those 8 wastes, but I don't remember what the 8th one was. You can go back and look. All right, so that's chapter 20. I'm spending a lot more time on this than I'd planned to. What about chapter 23 on taxes? Taxes, tax strategy. We talked a little bit about taxes in 3020. We'll get to that here in just a second, but what's your tax strategy? Well, it's always to accelerate deductions, right? Or delay reporting revenue. You want to push that out as far as possible, pay the taxes later instead of now. And then you have what? Deferred tax liabilities when you're paying it later versus deferred tax assets when you got to pay more tax now for some things, like receiving rent revenue or something in cash before the actual period in which is earned, or unearned revenue that you receive cash for, deferred tax asset. But accelerating deductions, you want to take all available tax credits. The next page, avoid non-allowable expenses, meals and entertainment. Of course, that's probably going to go down a lot now after this last couple of months in corporate America. increased tax deferrals, pay the tax later. Number 5 is a big one, obtain tax exempt income, investing in municipal bonds, which are federally tax free, and they are state tax free if the company is located in Tennessee. But that is a permanent difference. Remember the difference? You had temporary timing difference between deferred tax assets and deferred tax liabilities, temporary timing difference. Well, permanent differences are things like tax exempt income or life insurance premiums and proceeds are permanent differences. If you have a fine from OSHA or the EPA, those fines are what? They're disallowed. Well, of course, you want to what? Avoid non-allowable expenses. Of course, yeah, you want to avoid having to pay the fine to begin with, but if you pay the fine, that's not tax deductible. You have to add that back to your income. Comes off your books, right? But you have to pay tax on. That's a permanent difference. That's not a temporary difference. All right, tax organization. Usually this is all centralized. You look at page 435. Each individual plant usually doesn't have to do anything except send supporting documentation to the tax department. Corporate tax. Role of the tax manager on the next page. You can go through that job description, what all they have to do. And I tell you, a big part of this is going to be sales tax, which I think is in here somewhere. Next couple pages is going into detail about keeping good records, you can imagine. Working paper files, tax versus book accounting. I've already touched on that. Your deferred tax assets versus the deferred tax liabilities for temporary differences, temporary timing differences. That's like if you adopt MACRS for tax purposes, that's a declining balance, right? Accelerated depreciation. MACRS for taxes, and then you got straight line for financial reporting, and that difference, you're kicking it down to paying the tax later. Well, over time, the depreciation is the same over time if it's fully depreciated, but those are differences that you have there, timing differences. And that's what he's going into detail here. I don't know that he actually uses deferred tax asset, deferred tax liability, but that's in essence what it is. Sales and use tax. I've often said that we ought to have a whole course on sales and use tax, especially in Tennessee. That's a big one, huge, absolutely huge, sales and use taxes. I mean, you're paying 9.5%, maybe 9.75%, 7% of that is state. A lot of that stuff is, a lot of stuff you buy is non-taxable, it's exempt. If you had the industrial machinery exemption, if it's product that you're buying, that you're building, any machinery that touches that is non-taxable. And so you need to become a sales and use tax expert if you are working for a company in Tennessee, and you may spend a whole career in just sales and use tax, and you don't like to think about that. All right, continuing right on. We're going to jump into chapter 24, the final chapter. If I had a set of drums, I'd do a drum roll and hit the cymbals. All right, selecting a financial information system. I spent a lot of time in my career, early in my career, doing this, mainly because they looked to me as the most knowledgeable IT person in the accounting and finance areas. And so selecting a financial information system is a big task. And the more you know about systems, the more qualified you are to make a wise purchase. Why would you purchase the software versus hiring programmers to develop it? Well, it's usually cheaper. You may think I'm spending a lot of money on this, but at the same time, it's usually cheaper. Not to say that you may have some unique business, nuclear fuel where I started. Obviously, tracking uranium was critical, and they had a really good perpetual real time, which real time back then was unusual in the early 80s. Unusual. Most stuff was batch driven, meaning you accumulate transactions and then run that during lunch, end of the day, end of the week, or whatever. But it was real time of tracking inventory where you had to have that. And so nuclear fuel developed their own and was there. But the financial side of things at nuclear fuel, because the inventory of the uranium was never tied into the financial system. First software project I was on was with a payroll personnel or HR system, where we were going to implement a new system that eliminated all of these different databases and files that were in accounting and payroll, HR, something that could be out there for manpower scheduling. And so this purchase software, just a canned vanilla, as they call it, package that, I mean, the way you handle payroll and accounts payable and people is the same anywhere you go, whether it's NFS or Eastman or ETSU. So that's where you want to buy purchase software, some vanilla package versus something specific like we did for tracking uranium that was real time. But this payroll system went from being a batch system to this was a real time system. But you got a quicker implementation speed when you buy something already packaged. There's going to be less software problems, lower overall costs. You got vendor assistance, documentation. They're going to give you the documentation on how to use the system. Now, it doesn't mean you don't take that documentation, create your own user manual, which you do need to do, make your own user manual of how you're using that vanilla package, because there's a lot of features that you won't use because you just don't want to use everything that they have. You want to have user documentation that takes that canned documentation, puts it into forms that your employees can use. Training is big because these companies will, in a part of the purchase price, they will come in and do training with your folks, but they will also allow you to come to their site, whether it's in Atlanta, Georgia, or Montvale, New Jersey, or wherever it might be, California, and do on-site training as much as you want to travel there. Of course, you got to spend the money to go there, but they will allow as much of that as you want. Our payroll personnel system was from Montvale, New Jersey, and I would go up there to learn how to implement tax software updates to our payroll personnel system, because it handled all the tax reporting and so forth. But you need to have training on that on a regular basis. So I would go up to Montvale, New Jersey. Hated flying into Newark and driving up to upstate New Jersey just because it's such a hassle. But they allowed me to come up there as much as I wanted. Now, when we bought a accounts payable, purchasing, receiving, inventory, and this is non-nuclear inventory system, fixed assets, general ledger. When we bought that system 4 or 5 years later, most of that software came from Atlanta, Georgia. And so I spent a lot of time traveling to Atlanta, Georgia to do free training. Our general ledger package actually came from San Francisco. Didn't go out there very often, but I did go out there a couple of times for training. But training is something that's very important, and he does a great job here, because he's also got some job knowledge about this. User group, very important. I mean, if you're one of the people purchasing or one of the companies purchasing this package, who are the other companies that have purchased this? And you want to know who that is before you buy the package, and make sure they're using the same hardware, computer hardware, and operating system in their computer system, whether it's a mainframe or a server system. Make sure this software package and the people you talk to are the same, because anytime there's a software package, it's not just some canned vanilla package that works on every one of those is going to be a little bit different in how the job control language operates with your mainframe. So we had a DL1 database system. Well, there's also what's called vSAN, virtual storage access method. There's all types of different systems that you think it's the same, but it's not. You need to find out who's using that software that you're going to buy. Find out who has the same identical hierarchy or hierarchical structure of your database and your computer system. Very important. I don't think he really talks about that, but very important. But user groups, finding similar folks that you talk to before you buy it, as well as afterwards, to find out how they use the software, how they maximize the use of a vanilla package. Good stuff here. Next page. Start talking about an RFP, request for proposal, putting that together. What are your expectations? Because if you're looking at 3 or 4 different vendors, you want to make sure that you've got an RFP that is the same, that you're asking the same questions to each of those vendors. We've been doing the same thing here lately in the MAC program of really getting a software CPA study guide. You know, we've been using Becker and but we're looking at Becker, we looked at Wiley, and what was the other one? Rogers, maybe. There's another one there, but all four of those, Michelle came up with a questionnaire that try to keep things the same. And it's a lot simpler with looking at a CPA package for students for our MAC program and price that's agreeable. A lot easier to do that than buying these mainframe software systems. At the same time, it's the same process, an RFP. What does it cost? What are you getting for it? What kind of support is there? A lot of good stuff there. And so that's what you see on page 447 is a sample questionnaire for this. Things like, what reports do you prepare? And that's where that question 5 and 6 there, what reports do you prepare? What forms do you use? This is defining the application of what you're doing internally. You got to define what you're doing before you know what you want. And there he's talking about reports and forms. Where do these forms originate? You know, I talked about that several chapters ago. Where do these forms go when you complete them? Is it useless? And when you automate something like that or switch from one mainframe system to another or one software package to another, great opportunity to improve your processes and get rid of all the stuff that's just a waste of time, which a lot of people do stuff that's just, well, we've always done that. Why are we going to stop? Because nobody uses it and it's worthless. There he talks about document reviews. Vendor demonstrations, have people come in and give you a demonstration of their product. Ask them questions. You can tell by their body action and body English of whether or not you've asked them a question that they really would rather not answer or not sure. All right. Preparing the request for proposal, going on over 452, 453, so forth. Straw man, I like that term. They're getting rather specific about maybe the current system that you're using has certain lengths for a field being like a city, a street. Probably not as important there as some of the other things they don't even list here. But what's the new system? What does it offer? Is it going to be truncated or is it going to be longer or shorter or whatever? What about job pay history? Is that convertible over to your new system that allows to have job pay history? Because people like to go back and look at their computer screen and it's job pay history. You don't have to go to a file cabinet and look all that stuff up. All right, request for proposals, RFPs. Kind of like RFQ, you hear that as well, request for quote. Very similar. Reference calls on page 462. They make a point there on 456 about completed accounts payable system requirement. Enter invoices online. You want to be able to do that real time. Like it says, enter vendor credit memorandum for future payments. $5,000 additional fee. Edit for duplicate invoice numbers to the same vendor. Number 7. Really important because no system is worth having if it doesn't know that you're trying to process the same invoice number twice. That should be a red flag that you've already processed it, right? Yeah. Now what the 3,000 additional fee, I guess if we read the detail, we would know. Distribution of the request for proposal. It's a good desk manual. I would encourage you to keep this book or this text afterwards. If you've rented this, Alex actually found this online for free, so I can send you a text if you'd like to have it, or you can get it from Alex. All right, so that's pretty much chapter 24. The last page 466 talks about post-implementation review. I think he's talking about in terms of, did we get what we thought we were going to get? Well, before we get to that, I knew there was one thing, reference calls. And I've already alluded to this already. Make sure if you're ever buying software, talk to someone else that's using it. And not just say, yeah, we use American software for accounts payable, payroll, and inventory. Is it the same database, file system? file structure, and hardware, because you can have one they love it because it's being used for a VSAM system, and then a DL1 database system, it's a piece of junk because it's not been used enough to really iron out the bugs in it. Very different. So make sure you got an apples to apples comparison. But these are the questions you want to ask when you talk about reference costs before you buy it. How easy was it, the installation? Did operating system, database, see, they're talking about those things. Ease of operating system, database management system, hardware install, hardware dependability. Make sure you got an apples to apples comparison. And if you don't, if you're buying something from a reputable vendor, that you're buying something that appears to be the same package, but it's for a different operating system, you might have nightmares. Like we did that once, right? All right. And the last thing I want to point out here, post-implementation review on page 466. You know, I've talked about that with any type of capital project. To buy software at NFS, you didn't have to prove you're going to save money. This was just something we had to do. NFS was a subsidiary of Getty Oil when I joined them in 1983, and then Texaco bought them out. Well, Texaco sold out to a group of investors out of Atlanta, Georgia. 16 people bought from Texaco NFS, and they're the ones, since we were using through time sharing option out to Oklahoma where Texaco and Getty were, we had to buy some software for our system. So this is something we had to do. So there wasn't any post-implementation review, did we save money or not? But most companies now, you have to prove that you're going to save money. They're going to allow you to spend the money for the software anyway, unless you just have to get more modern. No, Lear, when I was down there, probably one of the reasons they hired me was they were trying to move, and they like to use the term migrate, from about 3 different systems to SAP. Exide was way ahead, believe it or not, way ahead of Lear in their system. It wasn't SAP, it was JD Edwards, but it's the same ERP type system, real time, integrated, track your inventory, all of that. But they were wanting to move to a SAP system for that reason. Probably don't have to prove they're saving money. It's almost like you have to do this that's just what you have to do to stay in business. So you might say you're going to go out of business if you're not in control of your operations. And they were not in control of their operations at Lear. They just, is like using a sledgehammer trying to get stuff done. But Exide, even though it didn't make any money, just because of the nature of the business Exide was in, had really good systems there that worked well. And again, they were going to move from JD Edwards to SAP because SAP is considered kind of the world leader. They weren't going to spend the money for that because it just wasn't worth the effort. Kind of like, why doesn't Food City have a real-time inventory system in their store? Steve Smith doesn't want to spend the money. He doesn't see the payback for that. I know how he's thinking. If it doesn't help you, your bottom line, right? Thought I'd throw that in there this final time. If it doesn't help your bottom line, then why do it? So they just have all their purchases that they track, obviously, if you're paying for it, and then do an inventory on a month or every 3 months in general. And whatever you purchase versus what you sell, that's your cost to get sold, right? Or your profit, real cost to get sold. Your inventory versus what your purchases are is your cost to get sold. And how much did you sell it for? Because when you check out, that's all driven based on point of sale. It's got your item number, the barcode number, maybe a description, and the price that they want to sell it for. That's all it is, based on what I've been told. And that makes sense. But if you've got a project that you're implementing this software, the post-implementation review, if it's tied to your capital budget, I mean, your auditors are going to look to see, did you save the money you said you're going to save? Very important. Post-implementation review. All right, so we are done. I appreciate each of you and your participation. I know the last 4 or 5 weeks have been different, but appreciate each of you. Y'all do a great job. Enjoy meeting each of you. Wish you luck in the future. Best wishes. I'm sure many of you are going to become controllers someday. if that's what you desire, you'll have that opportunity. Again, these 3 chapters, turn this in by 2 to 3 pages by next Thursday, week from Thursday, along with that Excel file. And then your final paper is due, I think I moved the date out a little bit instead of it being next Thursday. So the date is out there in D2L for you to turn that in. I think I've got May 3rd, I believe. But look at that and see. And the final thing is, I haven't looked since I sent you that other email about the SAIs. SAIs are very important to ETSU and the College of Business, especially this year with us going through the review with AACSB and them coming on site and us writing our 300-page paper. Half of that is just about accounting the MAC program to get our accreditation again for another 5 years. So it's a stressful time, but they look to those SAIs and be honest with them. Don't try to beat us up too bad, but be honest in your evaluation of this course, not the program in general, but just this course, and do it for each of your classes. Be honest in your evaluation, and also be forthright about, do you think asynchronous works for this course in the last half versus the first half? Or if asynchronous didn't work, I mean, we had to do the online whether we liked it or not. I know one of you would have rather have done the synchronous where we met every Thursday at 4, and I can understand that as well. But it seems like most students prefer asynchronous, but I don't know that. That's not data-driven analysis. That's just anecdotal. So comment about that if you have time. I mean, the survey itself probably doesn't take 2 minutes, but if you want to add some comments there about improving the course, let me know what it is so I can help those in the future, because it is all about the students and your learning. It's why we are here. At least that's why I'm here. And I think most of the folks in accounting are the same way, and the College of Business. But please take the time to do that, because it is about ETSU, which you are a part of. And with a MAC degree from here as well, and maybe you got your undergrad here, you're valuable to us as input, because we are partners. All right, so having said that, thank you. And I enjoyed meeting you, and I will talk to you soon.